Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 81. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management and Rich Diaz of Acorn Macro. Welcome back to the show, gentlemen. Keith, good to have you back on.
Hey, thanks, guys. I'm back again. I think some of you guys know, but we had some sadness in my family last week. My dad passed away, and so we're going through that as a family, and it's been a lot of really nice, warm well wishes to us last week. So thank you to everyone, and here we are back again this week. What's going on with you, Rich?
I tried to mix up my workout and I smoked my head on the side of the swimming pool while doing backstroke.
I was gonna say, I don't know if you were
and so
drinking
you can see
and hit your head.
the welt. No, I was not drinking. I was hot dogging in the swimming pool and I absolutely cracked my head on the side. So there you go. That's as exciting as it gets over here.
Flexing for the new chick at the pool, eh?
I was all alone, actually. But anyway, it's good to have Keith back. It's not the same without you, Keith. So welcome back. I'm sorry about your dad.
Hey, thank you for saying that.
So
good.
Yeah.
So you guys had a good time last week. Good conversation.
Yeah,
it was great.
Yeah.
We had a new boomer fill in there with Aaron O'Toole. So highly encourage everybody to go back and listen to that episode if you haven't already. But Keith, you were sorely missed. So welcome back to the show.
And I think now I understand there's a lot of people wanting to be a guest on our show now. So thank you, Aaron. That really helped out quite a bit. We do appreciate that. But lots of things happening in markets right now, and I think a few other shifts elsewhere. So let's jump into it. Now, Steve, you're traveling as well today, right? Because you don't look like you're in beautiful Vancouver.
Yeah, I'm in the dirty South, dirty Myrtle Beach here for a good friend. He's on Twitter there, Jared Dillion. He holds his annual Dirt Nap conference. So I'm here to actually speak on Canadian housing for the audience. So, I mean, I can trying to, maybe to frame up this week's podcast is really just what's happening in the housing market. So I'm going to come in, sort of demystify things, because I think for a lot of Americans, Canada's housing bubble situation is very, very people can't readily wrap their heads around it. And I'm by no means justifying the prices, but I think one thing that I'm, going to point out in my speech this week is when you get these charts that circulate on Twitter and social media that compare US housing to Canadian housing, and Canada's got this hockey stick, off the charts growth. The one thing I have to point out to the Americans is that 80% of Canada's house price index is basically Toronto and Vancouver. And so you essentially have it's basically okay, well, if you were to take Seattle and New York and put it on a home price index, I think that's how you have to look at it, because the reality is Canada actually has basically two major metros and everything else is just almost sub markets.
What about Montreal?
Okay, Montreal. We can throw Montreal in there. You can dabble Calgary.
No, I'm just kidding.
Dabble Ottawa. But the reality is most of when you talk about Canadian housing, you're really essentially referencing two markets, which is Vancouver and Toronto. They get all the media headlines. And I think that's where, your million immigrants a year, I mean, the majority of them end up flocking into Ontario. So
is that why the valuation metrics are so off the charts? So the house price to median income is I don't know, 8 or 9 for Canada, but I know it's 12 for Vancouver and 10 for Toronto or something, and then Montreal is 5, and then Calgary's 4 or something. So is that what you're talking about?
Yeah, I think so. I mean, I think you always have to look at the data, look at the charts, and then try to flush it out and say, okay, what am I missing here, right? I think I always look at it and say, if you're an American, think about all of the economic opportunities that you have. If you get priced out of New York, you can go to Nashville, Tennessee, Arizona, California, like all these major, like Boston. You can pick like any major metro city in the US, and there's tons of jobs, tons of so like it's very common for people in the US, right, to pack their bags and just relocate, somewhere in the 52 states. Whereas like Canada, it's like the reality is you're going to Vancouver, Toronto, like like not a whole lot of people are super excited to get to like Saskatchewan, Winnipeg, where housing actually is affordable.
So we just
we're
lost
gonna get some
10
grief.
We just lost our 10 listeners in
yeah, sorry about that.
Thanks a lot,
I
Steve.
mean, much love to those two provinces, but the reality is, it's like, you look at it, it's like what's the population of Saskatoon? It's a couple 100,000 people. That's like a small town in the US.
One thing that's interesting with this, like I know a lot of managers, they're not Canadian based, they're outside. So that, they're running interesting, books. And like in that space, you're always looking for an asymmetrical opportunity. So that means, you can just allocate a small amount of your risk capital to that strategy. If it doesn't pay off, it's like an insurance policy. Maybe you lose a half a point or 1 or 2, whatever you have your risk metrics for it. But if it does pay off, it becomes this, X return, 1X, 5X, or 10X, something like that. And so, and because of the metrics in Canada, with housing, and all the knockoff, spin-offs from that, Canada's very attractive to these guys. And, it's one of these things, hey, it hasn't paid off yet, but I think people should realize, understand that investors, when they take a short position sometimes in something like one of these events, and it doesn't happen, they're not losing money in their mind, because they're just putting in like a safety, like an insurance allocation, because just in case it does, it's wow, kaboom. And it should say, like, the metrics in Canada are like they are off the charts, and it's very easy to rationalize why they should be at that level and so forth. But as long as we remain at this level, that there's always going to be money coming in to play against, this turning the other way. And so it'll always stay in the media. It'll always stay in the media news.
Yeah. I mean, I think my big thing is I'm not sitting here, obviously the real estate guy, trying to justify the values, but I think it's like, I think it provides some important context. I still think the valuations are obviously, obscene. I think it's incredibly expensive. Vancouver is one of the most expensive cities, I think, in the entire world. It's interesting, just anecdotally. I know we've chatted about it on the podcast. I don't have a whole lot of new data to release for this week's episode, but I can tell you, like, anecdotally on the ground, market continues to heat up, and actually incredibly surprising. Like, I know, like, half jokingly, like, we called the bottom, a couple months ago, but like, honestly, what I'm seeing right now is actually a little bit concerning. Like, prices are moving up aggressively. This isn't like, oh, it's a spring market blip. Like, there's no inventory. Like, we're seeing, like, I'm going to, like, how detached houses in the west side of Vancouver at $3.2 million, and there's 50 pairs of shoes at the front door, and these houses are going into multiple offers. Like, it's something. So something is going on. It's crazy because there's still, like, so many risks out there. We keep talking about, like, recession and banks failing and of that nature in the US, but, like, man, it's all out right now in the Vancouver, and what I'm hearing in the GTA market, the Calgary market. Things are tight.
So Steve has the opportunity to become a bigger legend than he currently is, because he did. By the way, you just said we call the bottom. No, it wasn't a we. You did,
and it wasn't a joke either.
Yeah, you were quite serious, and people were like, oh, no way, but you were spot on. But Steve, now we have the opportunity to call the next top, and that will put you. That would put you up there, like, on Rich level,
Oh,
with,
boy.
some things, some factors.
Yeah, we'll see. It's worth watching. But
I have a question. Just like, we talk about valuations. How I don't get the affordability. I think, we've mentioned this, and maybe we've been wrong about this. We talked about the great rate reset. When mortgage rates go from 2 to 4, people are going to it's going to feed in, and people are going to have to really tighten their belts to be able to pay for their mortgages. But the other end of that is also true in the sense if you're buying this house that you're saying that is getting, you know, lots and lots of viewings and etc. The mortgage rates are now at 5 and 6 and whatever percent. I mean, who can afford these types of mortgages? Are these homes being purchased with cash? Or is it, you know, is it 50% down? Is it rather than 20% down? Like how are these people paying, or is everyone just very, very wealthy in Vancouver and you know,
I mean, that's a good question, because I get that like all the time. People that like live and work and earn an income in Vancouver and pay 50% tax rates are like, I don't get it. I'm a top X% income earner, and these numbers don't make any sense to me. I think the reality is that there's a lot of capital sloshing around. It is a breathing ground for foreign capital coming in, i.e. you own a business in Hong Kong and you pay 15% flat tax in Hong Kong, and you bring your cash over here, and you have a Canadian citizenship because we give those out like candy, and you're buying real estate, and you're sending your kids to school here, and then, you know, the crazy stat is 50% of houses in Vancouver, 50% of the detached houses in Vancouver are mortgage free for their primary residence. So there's a lot of like, and so what we see is like, you know, families, mom and dad bought their house 40 years ago for a couple $100,000. It's now worth $4 million, and they stroke a check to their kid for $500,000 for a down payment. That's how they get into the market. So it is like, you kind of have to already be like established in the market, or you have to be earning your income sort of elsewhere to really, I think, get into some of these more expensive and prestigious markets in parts of Vancouver. And I think you can apply the same logic for Toronto.
Because like when you just, you know, share that, if you say you are a young couple, you know, early 30s, say you're in that range, I consider that young, of course. but say you're there, Steve, and with that situation, for what you're seeing and hearing, how much is their down payment on a house? Like, do they have $100,000 they're putting down, 50, 400? And besides getting help from, you know, generational wealth, like you say, where are they getting it? Or have they saved every nickel and dime for 10 years?
Yeah, I don't find like people are actually saving like, hey, I have a, you know, normal T4 job and I've been saving for 13 years. Like you don't really see that. It's impossible. It is impossible. You know, people run the math and say, oh, it takes 20 years to save for the average down payment. Well, I can tell you, like, nobody's actually saving for 20 years. Like, there is, you know, either you're making money off whatever stocks or real estate, and that provides the down payment for the next place, or you are getting some sort of, we call it like the front on your inheritance, right? Yeah, your parents are alive, they're in their 60s, but, you know, they're looking at it and say, well, it's basically like, I'd rather like stroke a check for $200,000 to have my kid and my grandkids live within 30 minutes of me. Otherwise they're going to have to relocate to, you know, sorry, Winnipeg, you know, so that's how they view it. They're like, I want our kids and our grandkids to be close. So they'd rather so that's what we're seeing. And like I said, I've said it before. Is it a just system? I think it is unfortunate that if your parents weren't on the housing ladder or are fairly well off, you have an uphill battle as a young person trying to enter the housing market. And that's just the reality. And, you know, so.
Okay. So one interesting thing that you did say then with that narrative was that, you know, someone in Hong Kong, they raise capital there, and then they're bringing that to Vancouver. You know, as Canadians, we think, oh, wow, that's awesome. You know, people want to live here. But the other side, the flip side, of course, you know, they're leaving another market. And I think that's the way markets work. You know, think of capital. It's when it's fluid and liquid and it's able to move, you know, it will stay in a market as long as possible, you know, to generate, you know, a good return, things like that. But once they're always trying to get out, and that, you know, that's what's happening with China and Hong Kong these days. You know, they get out of the system. So what my point is that it doesn't necessarily mean Canada is awesome. Sometimes it just means people are just trying to get, you know, the money hell out of that part of the world. And then there's also a lot of people, you know, they're not interested in putting their money in the US, you know, for tax reasons. Because if for some reason you do back into a US tax problem, you have that problem your whole life. Those guys don't let go. But okay, cool. We hit that. Rich hit his head. What are we going to hit next?
Well, I mean, just if you want to segue here, I mean, we were talking about people trying to save their money on their, on their T4 jobs, trying to get into the housing market here. Rich, we had some updated on the wage data in Canada, I think yesterday.
Yes. Yeah, no, it's today. So wage growth, and there's different ways to measure wage growth. There's annual weekly earnings, there's average hourly earnings. There's no right way, there's no wrong way. I think when you had during the pandemic, when you had loads of people basically not work, a lot of the wage growth data spiked. I think in Canada went up all the way to 8.5%, 9%. That's obviously a sampling issue. So when you guys see the chart and the chart ticks along at 3 and 4 and whatever it is, and then it just jumps, it's because obviously the people who kept their jobs work behind laptops and were basically white collar workers, and all these blue collar people got thrown to the street because of lockdowns. Let's not get into that quagmire. But so that's why you saw, because of a sampling issue, you saw and the reason that's a preamble, it's important because when I eventually show the chart, and we show the chart on YouTube and in our Substack or whatever, you're going to see this giant spike. So you're going to say, oh, that doesn't make any sense. So that's why. But so the reality is the wage growth fell, and last month was revised down. So if average weekly earnings fell to 1.85% year on year. Now, let's all remember what inflation is. Again, depending on how you calculate it, inflation is 4, 5, 6. And people have, given us crap for saying it's undercalculated. It's underestimated. I agree. And so that's why real wage growth is the lowest it's been according to the series that we have. And so real wage growth, which is wage growth adjusted for inflation, is now negative 3% in Canada. So, I mean,
how far back is that data series?
Excuse me, that's a good question. So it goes back to 1995. So, I mean, I'm sure I can rustle up a better one, but that's still nearly 20 odd years. That's pretty good. A couple of cycles. I think what's more important is to contrast that wage growth, nominal wage growth. Let's leave aside real wage for a second, with the U.S. wage growth. And the U.S. is having the best wage growth it's had in basically a generation. So I'm trying to quickly find the chart, but you have wage growth depending on what your age is and depending on which kind of income cohort you have. You're having wage growth of 5, 6, 7, 8, 9%, which is an incredible difference. Yes, sir.
A question for you. For the wage growth calculation, does that include bonuses as well, or is it
so yeah,
per
so in
hour
Canada,
workers?
Yeah, so in Canada I don't think they have it. If someone can find that and correct me if I'm wrong, I'm happy to. In the UK, they split it out. So in the UK, I know for a fact that they do regular wages and including bonuses. But it's often quite the same. Obviously, in the UK, they have better data with respect to public and private wage growth is actually usually higher than public wage growth, believe it or not, folks. It is in the UK. I'm not sure what it is in Canada. We'll find out in a couple of weeks what happens to the strike, of course. But yeah, just to finish up, like the US, their wage growth for the poorest quartile is 7.1% in the US, and that's the highest it's been since 1998. And Canada, it's just the total opposite. So you have just slowing wage growth. I don't want to say the P word again, but I'm sure it has something to do with that. When you invite loads and loads of people into your country that are all between the ages of 20 and 50, it obviously has a depressive impact on your wage growth. Also, we just have worse growth, full stop. But what's really fascinating is the US has had positive real wage growth, again, depending on how you calculate it, for the last year or so. And Canada's real wages continue to fall. And so we'll talk about some other recession indicators. I think you want to talk about some slowing growth stuff, the Keith, that you wanted to mention, but I just thought it was really kind of a fascinating number. I wasn't expecting that. I've always talked about how labor markets are a lagging indicator. And so I was actually expecting a little bit more positive news on the wage growth front before the eventual sort of decline, and to see it come down like that, and also to see last month's number be revised down as well, was a little bit surprising to me.
I mean, if you're Tiff Macklem, you got to be pretty happy about that. No, that's probably one of your larger concerns, and saying, real negative wage growth of -3, 1.85, you said, that doesn't seem very inflationary.
No, it doesn't. That's a really good point, Steve. I can't speak to what the guy's thinking, but you're right. I mean, just as simply put, I think when you have wage growth, wage pressures falling, what was released was just the total. In the next couple of weeks, we'll get manufacturing and services, so that will be really interesting. I imagine it'll come down as well. But the counterpoint though is when you just have an incredible amount of people enter in an economy, that's a very inflationary, it's an inflationary impulse. So I think there's a balance there we sort of have to figure out. I haven't figured it out yet, but yeah, it's more bad news on the wage growth front, and no one wants to hear that. Sorry, folks, but that's what's going on.
Yeah, you get basically real negative wage growth. You have, declining per capita GDP.
Yeah, keep going.
And then you've got this housing crisis. I don't know. It's just
tighter lending standards. Right. We know that. And for some reason, the way house prices are going up. So, I mean, I'm as confused as
it's hard to square. Keith, what are you thinking?
Well, it's kind of interesting because, today, I think it was today or yesterday, the CMHC came out with their report, and they talked about how, my notes here, they're expecting a housing start to decline 32% over the next, is it 12 months, Steve? I don't remember what the time frame is.
Yeah, I mean, I think we mentioned it briefly on last week's episode, but housing starts have come down. They hit about a cycle high, I think about a year ago, about 300,000 annual housing starts. That's using a 3-month rolling average, and now they're down to about 230,000. So yeah, not great if you're looking 2, 3, 4 years out and trying to sort of alleviate a housing crunch.
Yeah, but it goes back to the the theme here. We're all a little confused a little bit, but we're also seeing the narrative to support different investment themes, because that's what we're doing really. So the housing start, the inventory side or supply side, viewing the supply demand curves, it makes total sense. But going back to an investor who's looking for one of these asymmetric opportunities, you're just thinking, what, all we need here is a recession to come up, and maybe it could bump things off, which ties into the Bank of Canada this week. So they I saw 2 messages they pushed out this week. One was in a like a Q&A type presser with that Tiff did, I think it was today or yesterday, but he basically said, we're likely headed for 2 consecutive quarters of zero or near zero growth, which is a recession. And I don't know what the reaction to that is going to be, but that's what they want. That's what they've been trying to do. So if you reduce aggregate demand for the country, it will bring down the economy, as well as, in theory, inflation. Considering that the supply side catches up as well, we have that going on, because, by the way, when you shut down the global economy, you ain't never getting it back to where you thought it was going to be.
You don't say, Boomer.
Yeah,
you don't say.
You guys know my views on that stuff. So,
did anybody ask Tiff Macklin if he knew that per capita GDP had already had 2 negative quarters and is about to have a 3rd one, or did they miss that?
No, I think though, like if there's any official media, unlike Loonie Hour Media Inc., our national media company,
Free plug.
That's right.
Yeah, we don't have access, to these presser pools. But if someone is listening.
I was actually told that we can apply for it, but I don't know.
Oh man,
I'll let one of you guys do.
I'm
banned. I'm banned for sure. I'm for sure.
No way.
Banned.
So if we do get that, special badge, we're able to log in, and 3 of us have the magic vote. Who gets to go to do it. So for everyone to understand, like the first round of voting, it'll be a 3-way tie. But after some haggling on the side, Rich is going to win 3-0. So
I'll abstain. You think they won't let me ask Tiff Macklin any questions?
Could you imagine, Tiff? And the next question is from Loonie Hour Media Inc. Keith Boomer Dicker.
That's right.
Go ahead, Keith.
But I think it'd be fun. But on a serious note, the questions that Rich is bringing up, these are the kind of conversations that need to happen. Instead of these softball type questions all the time. And then the other so again, the comment that Macklin made about negative or near zero GDP growth recession, he's 100% correct. That's what we need to bring, inflation down. It also means some folks might lose their jobs, and stuff like that. And by the way, when I use the word folks, I'm referencing someone else in our history that people should catch on with maybe. But the other note was kind of bizarre. It wasn't from him, but the Bank of Canada this week, they disclosed the climate-related risk to the Bank of Canada and to the economy, and they're really gone down. I just thought it was bizarre for central bank to be doing that.
Don't get rich going.
Yeah, but
the
it
EU does that funny business too, by the way.
Yeah, and I don't think that's where we should be going, because it implies that credit should be allocated based on some subjective scale that somebody made that turns out may or may not be correct. And it goes back to, again, like with the central bank digital currency conversations that are out there, we know this is coming. Like, this is 99% sure it is coming down the road. And why do I say that? Because they keep telling us it's coming. I mean, that's where we're at. And then for the Bank of Canada to start referencing, climate change and their risk analysis of the economy and stuff like that, again, it just says, maybe they might be focused, in our opinion, on, in the wrong parts of the economy where we're going. So back again, I think we are set up for something a bit odd to happen. And I think at some point, I think we'll jump over to the U.S. Bank depository, because I want to talk about
I think that sort of circles with the bigger picture stuff. I know, like Russell Napier, who's been a great interview. We should get him on the show, but he's talked a lot about this new sort of regime or paradigm that we're entering, which is the allocation of credit will be dictated more and more so by government, and so they're going to decide where credit and capital gets allocated through their policies.
Well, we talked about that last week, didn't we? Didn't we talk? Sorry to steal, but Keith, we talked about that last week, where they want to give people with a lower credit rating a better mortgage rate.
In the U.S.,
you heard that right, by the way. That's stupid. That's the total opposite of how finance and economics should work. And when this inevitably blows up in our face, just remember that we said that here first, folks. It's bananas. Sorry, Keith. Keep going.
Well, Rich, you are right. That's the way it would work in a capitalistic society. When you're leaning towards socialism, borderline communism, then my guys, that's where we're headed, guys. That's the decisions that will happen. And really, we see this in the movies, like with Hollywood cinema and stuff. You get your social, what do they call it? Your social media
social credit score.
No, it's social credits. Yeah.
It's the exact same thing. And people might be rolling their eyes, whatever, but we're starting to see these comments come again. This is not coming from the Loonie Hour. This is from the Bank of Canada.
And the BIS, the Bank of International Settlements, the gentleman who runs that has made it very, very clear about his intentions with respect to the central bank digital currencies and why they think it's interesting and important. Sorry, Keith.
Mm-hmm. Yeah, and so we're going in that direction. And again, like I continuously use this phrase, and I think it's an awesome phrase as well, by the way. We have, global risk has indeed been synchronized around the world. And if that wasn't the case, you wouldn't have this, confluence of all these major countries believing in the same thing, saying the same thing over and over and over, because they know that, we've been on this, 40, 50-year credit cycle. It's been driven by continuously lower and lower rates. And, we bottomed in 08, 09. And they suppressed price discovery across the whole yield curve, for about 12 years. All of a sudden, all this is being repriced again. And so these are the reactions we're getting that's coming out from it.
Just kind of on that, like, long-term debt super cycle. I know, like, we've chatted about it on the show. I know, like, Ray Dalio's written a ton of work on it. I mean, that's kind of like part of my real estate thesis anyways, is like, like when people are like, I don't get it, I can't square the numbers, like Canadian housing, but you go to the US and they're having the same conversations. So right now, like US housing is really ramping up again. And people are like, well, if you run the math on houses, like, at these interest rates and at these prices, like nobody can afford it. And yet like the housing market in the US is accelerating to the upside as well. And so I just start to wonder if we're kind of like in the society where I think the social frictions are increasing and you have this growing wealth inequality.
It's asset inequality. I think a lot of the times we focus on income, and I think that's a huge mistake. And it's something politicians always do, and it drives me absolutely crazy. They say, "Oh, it's income inequality is the problem, and we need to raise taxes on the richest people." That's in Canada. If you're the 1%, you're paying 50%. In Quebec, 53% of your marginal income. It's asset inequality. And that's why I hate central bankers, because by continuing to suppress interest rates for as long as they did, they basically just handed over an incredible amount of wealth from the labor class to the capital class. And now we're seeing the effects of that, whether it's through, social frictions, like you said. Keith's going to talk about how we deal with it sort of down the road, which is basically in somehow some debt jubilee, basically, which will again benefit the asset holders. It's really, really frustrating to anyone who's paid attention to history and that kind of stuff. But it's just it's just mind boggling how we're all just sort of sleepwalking into this.
So, Rich, by you saying you dislike central bankers,
I dislike central bankers.
Yeah, I think it's a brilliant statement, because you're either like completely eliminating a pool of, if you look at the policymakers plus support staff and stuff like that, for say the Western world and elsewhere, you're probably eliminating about a dating pool of 10,000 people, maybe 25,000. But it could be brilliant as well, because maybe it just makes you that much more attractive. So it's a good statement.
I just think it's so. Maybe hate's a really strong word. I apologize. I shouldn't use the H word. But to me, it's just, when it does blow up, I feel like we know exactly where to point the finger, and I think it's just very frustrating to me. I think it relates and carries on to a lot of these different things, like permanently negative real interest rates induces a misallocation of capital. We've mentioned that before. It's why people in Canada don't invest in small businesses. It's why the only reason they feel like they can get wealthy is by sort of recirculating their cash into real estate, which, sorry, Steve, is not a productive asset, instead of research and development, et cetera.
Resell condos.
There's loads and loads of knock-on effects, and it's to me, it's a directly result of sustained negative real interest rates. I could go on and on, so I'll stop now. But it's just, it's good to have you get back, Keith.
Well, I love listening to you guys. You guys, you're triggering some thoughts for me. But you mentioned small businesses, Rich, and so with that sort of, that immediately triggers my mind then to look at the bank deposit story down in America,
right?
And so I just want to phrase a narrative for everyone now just to start thinking about. And because the narrative that we have for 2023 with financial markets and the economy, it's going exactly in that direction. Like that's where we're headed. And but right now, what's really interesting with the U.S. banks, so both small and medium and in the large U.S. bank, they're losing deposits. That's what's happening. And so instead of putting your money on deposit at the bank, you're putting in a money market fund. So as an investor, the reason you're doing that, because now you have all of a sudden less downside risk. So instead of taking on the credit risk of a single bank, your money is spread out across really 30-day, 18, 20-day paper, across some really high credit ranking, corporate entities. But when that happens, so for every dollar that comes out as deposits from the banking system, and so that then has resulted anywhere from say $10 to $30 in loans not being available for the economy, right? Because banks are levered entities. Take a deposit out, the bank can't lever that out to lend. That doesn't hurt big companies, because like big, large companies, like whether it's, think of anyone you want to think of in your head, like they're able to borrow directly to the market. They're the ones that are issuing commercial paper that goes into the money market funds. But small to medium-sized businesses, and this is where I thought of this, Rich, they access credit through the banking system. And if all of a sudden there's less credit available for the small and medium-sized business, and they're the guys that run the economy, they're the drivers here. If credit is available, it's more expensive, it's harder to access and everything. We like one of these asymmetrical narratives that we're headed towards now is that we could run into a pretty severe credit crunch because of what central banks have done over the latest cycle. Again, they're driving deposits out of the commercial banking system and in the money market and stuff like that. But this is something that we're thinking about right now. So if we get a credit crunch in the economy, like it immediately creates a pretty severe bear market in corporate debt. There's something to think about. And then that takes care of your inflation story, guys. Because when you get a bond market breaking, that's like incredibly deflationary on this system. And in a way,
it's funny you should mention that because you can look at European corporate credit. I know it's not that liquid a market. Those spreads are actually starting to rise, even though the equity market is actually been doing okay. You're starting to see the spreads not come in. So and U.S. corporate credit spreads they haven't come in at all either. So there's like two different stories being told here. The equity market's been relatively stable and okay, flirting with that 4,200 level in the U.S. European equities are actually doing really solidly, but the corporate credit spreads, whether it's CCC or other high yield products, have actually remain quite wide. So I always find it fun when there's two separate and competing and sort of differentiated narratives, and that's something I pay attention to.
Keith, how are you positioning right now, like client portfolios in general? Again, you don't have to give us like the exact specifics, but like how do you position for this? I mean, it feels like the data is somewhat conflicting these days, right? I mean, like one week it's softness and inflation, the next week it's job openings are still rising. And so like the data doesn't seem to be that, like, and people, there seems to be a consensus that we'll probably enter some sort of recession, but some people saying it's going to be a hard landing. Others say soft to no, like it seems very uncertain the next 3 to 6 months.
Well, for our favorite realtor who's a client, we have him positioned to short the housing market just as an offset.
I got to hedge my bets here.
Yeah, so there's 50 million right now short the Canadian housing market. But so the market you just described, it's one where there's not a lot of certainty of where we may go. And that's not a bad market. It just means that you shouldn't be positioned to be all in one market or all out of another. I always chuckle when you see someone, we're always in equities, we're always hunting for the great new equity, grow the dividends, no retirement. Like that's not our style. And I think you're always going to get cut off at the knees eventually with something like that. But I talked about our narrative earlier. Our narrative this year is that equity markets as well as commodities will come down Q1 and into Q2, and that's kind of where we've gone right now. Our expectation also was the economy to really start to slow down in Q1 and Q2. That seems like it's being pushed out to Q3 and Q4. So maybe we get equities and commodities like sort of getting extended out a bit more. But as long as we continue on this path we're going on here, we could potentially get a bottom in equities as well as commodities, just as we're starting to hit a recession. And that will be your time to start buying, right? That's when you want to get a bit more aggressive. Doesn't mean you go all in or anything, but because usually equities will bottom just as the economy is entering recession. And like as Rich will tell you, you never know you are in a recession until about 3 to 4 quarters after it's already happened, right? That's the way it is. So we're going down that road. In all of our portfolios, we always hold an allocation to protect us, in case the shit hits the fan, which seems to be happening more frequently these days. So we're not worried or concerned, and we're having a good start to the year, and we're not getting any of this volatility that's already going on.
Interesting. Yeah. Well, it's one of the Canadian stalwarts here, CN Rail, just reported earnings on April 24th here, and they said, quote, "Our current volumes reflect that we are in a mild recession." That was from their CEO, saying that we're uncertain about how deep or how long it will go on, but what we're modeling is negative North American industrial production for the full year. And of course, they reported that their volumes were down 6% so far this month.
Steve, can I ask you an annoying question? Did they mention carloads versus intermodal? Sorry, that's like a really technical
I did
question.
not get into the depths of that. I am not a CN Rail equity analyst, but I am good at reading headlines.
Okay, no, because just to follow up, because trains work either like literally just like a bucket, like a rectangular bucket that sits on one of their, whatever sits on the track, or there's like an intermodal, which is if you think of like a Costco a Costco like a tanker, those like Lego blocks. That's called an intermodal. And it's usually there's a specific difference as to, one is related to commodities and sort of raw materials, and the other one is much more related to sort of consumer goods, etc. And sorry, I had
Listen,
to ask.
nerd, he said we're in a recession. All right.
I was kind of hoping like
hard questions.
Yeah, with Richard like knocking his head, like I was thinking, hey, maybe it'll turn him into
the Fonz.
Well, yeah. I mean, that's the ultimate goal for all of us. But tying into that, we had UPS come out as well with their earnings, and the headline being like UPS beats on earnings, but the key message was that they missed on revenue on the top side, and one of the key metrics you want, like a forward-looking indicator, you want to look at the transports in the market, because they're a pretty good. They give you a good vision on where the economy is headed. And that doesn't mean like things are falling off a cliff, but things are getting softer here. Of course, that means, hey, everyone's watching the Fed. What are they going to do? Which brings us to today's U.S. GDP number, which I think we should talk about a little bit, or a lot, or not. Which one, Steve?
Rich?
I think we should discuss it a little bit. Go ahead.
So, by the way, for the listeners, that means I'm the only one who read about the U.S. GDP.
That's exactly right.
No, it was a quite. I mean, I'm getting back to my hotel here, but it looks like it was quite a big miss to the downside.
Yeah. So,
walk us through that.
Yeah. So Steve defers to Rich first, and Rich defers to me, and I go back to Steve. So the bottom line, it looked like a miss. That the number was softer, and basically the prices paid number was a lot stronger. That means, oh man, this is a stagflation. It's classic stagflation. And stagflation means inflation is going up or it's not coming down, and growth is coming down. And really, if growth is coming down, prices should come down with it. Right, because one sort of pulls the other or pushes the other, and but the interesting thing today with the American GDP number, if you have some time, look into it. Consumer spending was good, like it wasn't bad, and as well, the reason the GDP number missed expectations is probably because of inventories.
Correct.
So you can view this, good or bad, depending on which way you want to lean. So when companies are building inventories, that increases GDP because it means they're spending, right? They're spending money to make stuff to put on the shelves. When inventories are declining across the country at an aggregate level, it means, hey, companies are selling stuff, but they've made the decision not to replace them as fast. So if that's happening, it's the reason why GDP was a bit less than market was expecting. So it's a bit of like good and bad with it. If you're a bull, you're saying, hey, consumers still spending.
Yeah, just to chime in there, Keith, just to kind of round it out. So yeah, GDP rose by an annualized 1.1% in the first quarter. That was less than the median forecast for 1.9% in Bloomberg's survey. So the economists miss again.
But that's a big miss for GDP.
Yeah, it's a big miss.
Yeah. But when you go into the data behind it, markets, they are, it's risk on today because they are interpreting that as oh wow, the economy is coming off hard, the Fed's going to not raise rates anymore, and so forth. My thoughts on this and my perspective is that the Fed has been, they've been pretty consistent. That they continue to look at the inflation data, and they will look at the prices paid within the metric. So I think anyone expecting the Fed is now, they paused. That may not be correct at this point. So we'll see where she goes, Rich.
Well, there's so many cuts priced in. I find it still crazy how much the Fed fund futures or other instruments that sort of are used to bet on the path and direction of interest rates for the United States. There's a similar thing in Canada. They use it called overnight index swaps, and there are different ones in the UK and whatever. But it's just there's so many cuts priced in, and I still, after all this time, still don't really buy it. But I think I guess the market's just focused on that, and I guess we just got another day of what is it? Bad news is good news, Keith. I love that.
So our next Twinkie bet. Well, somebody else suggested something different than the Twinkie recently.
No, we got to do the dunking. You got to dunk the politicians.
Oh yeah,
that's right.
Yeah, you get to dunk your favorite or least.
Where was
that
for the people?
It was in Italy. It was in Italy, and it was a great story, right? It was a small town in Italy, and the mayor, whichever politician does the worst job or something, gets put in a cage and then lowered into the river.
Do they hold the cage down for a certain duration of time?
No. I think it's just like up to his waist or whatever.
But
500 years ago, it would have been all the way under. But we're soft now.
Yeah, but I think it's good. I mean, we can go into this, 10 feet deep, but.
We should do that. We should do that like the next live Loonie Hour event.
That's right.
Yeah, we can dunk someone. But anyway, the other thing I think that was sort of interesting this week is, we sort of goes along those lines. So we still have the PSAC strike is happening, and so I think it's 150,000,
130,000, something like that. Anyways, quite a few people.
I think it keeps going up and down. Hey, the number. I don't even think they know how many people are in the union.
Well, I mean, a lot less.
No, they collect union.
So.
They collect union dues. They know exactly how many people.
Yeah, that's a fair point. But there's a Bloomberg article, and this is the quote from it. It specifically said the Canadian government is grappling with what comes after a forced experiment of remote work from home because of the pandemic.
Well, apparently people are all up in arms because they want them. I guess part of the negotiations is they want them back in the office 2 days a week.
Yeah, I know, and it's either I think personally I can make up a lot of arguments why. I know, for example, people that we deal with down in the U.S. and one lady's in Philadelphia, and she was commuting almost 3 hours a day, in and out, right, to do like administrative type job at this firm we do some work with, and. All of a sudden she goes in once a week, and Rich, come up with a number. How many hours a week is she saving?
15.
Yeah, absolutely. Yeah, your head knock wasn't that severe.
That's right. Maybe it helped. It's helping.
Yeah, it goes both ways, right? But what caught me with that article was that the government, they're trying to figure out that maybe all these policies they put in place back during the pandemic. They are having these, adverse reactions, years later.
You don't say.
Yeah, and they're going to continue for quite some time, like as we go here. But we'll see. Maybe they'll invoke the Emergencies Act. No,
aren't they storming aren't they blockading in the buildings in Ottawa? I thought I read that somewhere.
You guys are cruising for bruising. Thank God Bill C-11 passed, and our Canadian content will be pushed upon Canadians despite our what is it called, unacceptable views.
Is it actually fully through now? Like
I think so.
I thought it was going through like I don't know the exact process there. Like
the Senate readings or whatever.
Yeah,
well, actually, you know what? Soon enough, am I allowed to reveal this? We're trying to get a guest on actually who's an expert in this, and over the next couple of months, we'll hopefully have him online, and we'll interview him, and he'll answer all of our questions related to this. So, Yeah, there you go. There's a little tease for you. That's what they call.
Do we
a tease
actually
in the
think it's going to
business.
help the Loonie Hour?
I genuinely do, but we'll find out. We'll ask the gentleman who's going to come, who's agreed to come on, and he'll let us know.
Loonie Hour Media Inc. Just
That's right.
pulling in. We get a bump to the top of the Bloomberg, BNN Bloomberg request for Tiff Macklin.
Yeah.
People are really upset about that, eh?
Yeah, I know.
It was kind
They
of
are.
funny. I don't know if you guys realized, but on Bloomberg, under the message system, that you use on it, you can put your own little, it was meant to put an inspirational quote at the top. So whenever you sent someone, they call it an IM, an instant message on Bloomberg. You see it come from Keith, and it'll have like a little, the sky is blue, whatever you want to say. And a few years back when I was on the island, one night, and it's a small island, right? So you hear all the stories, and by the time you really hear it, some of it is true and some of it is not so true. Anyway, like some guy, Bob, got thrown in the drunk tank the night before. And yeah, and then Bob wasn't at his desk, at his trade desk in the morning. Not with my firm, or other one. Anyway, someone puts on his Bloomberg thing like "Free Bob," and then people start seeing it, and then all of a sudden this starts going around the world. Everyone, like in the Bloomberg world, like it's like everyone's like, who's Bob? Who's Bob? Why are you trying to free him? Anyway, that story went for about 3 days, and finally Bob showed up for work again. And guess what?
What?
That's where you say what, Rich. Yeah.
Wow.
He wasn't in the drunk tank. He went to New York for the weekend. No one already knew. Yeah.
Well,
But,
that reminds me of Ferris Bueller's Day Off, when he's like, he's got a sore throat, and before you know it, they're like, it's a great movie. What is it? He's like cancer or something, and everybody and his sister is really upset. Sorry, that reminds me of that movie.
Yeah, that was like I remember watching that like when I was a lot younger than
40.
you guys.
Well,
What else
I
you got,
think-
Steve? What else?
I think that's it. I think it's a slower news week. I mean, I hate to cut the Loonie Hour short here. It's a rare occurrence, but we had an hour and 10-minute long episode with Aaron O'Toole last week. So at the end of the day, if this one's 50 minutes, too bad. It balances out. And
There
there's
she
no
was.
sense. Yeah, well, Keith's got to get the Pinot. It's happy hour time here. The Pinot Noir is about to start flowing, so we'll let you get to that. Keith, it's good to have you back on the show. Condolences to the family, of course. We obviously had some nice mail coming through from some of the Loonie Hour community, so we do appreciate that. Keith appreciates that especially. And like I said, all we ask that we continue to share this episode with at least one friend or family member, continue to build the community here, and we'll see you again next week.